So I want to go over a brief history of the S&P futures. It's important to understand volatility, history, how markets change. And so the S&P futures, it started trading in the pit in 1982. And that picture there is much older than 1982. That's probably back in the 30s. So trade station data goes all the way back to April 1982 for the S&P futures. And the monthly range in January of 1984 was 13.15 points. So imagine that. The daily ranges are bigger than that now. The tick size on the S&P futures was 0.05. You know, now on the E-minis it's 0.25. And it's $500 per point. So every time the S&P went from, say, 500 to 501, that was $500 of profit or loss, depending on your position in that market. Here is the indicator we're going to use. It's the average daily dollar range indicator, easy language code. It's 3 lines of code. We're basically multiplying a point value, and we're going to start with 500 because that was the old point value, times the average of the high minus the low of the last 12. And so we're going to be looking at monthly charts to give us a broader picture of this monthly dollar range in the S&P futures. So that is the easy language code. Very, very simple. You can insert that strategy, and what happens is you get a chart that looks like this. Here are the pit S&P 500 futures from April of 1982 to November of 1997. And you see what you see here is back in, well, this doesn't go, it didn't go back to 1984, but you see back in at the very beginning back here, there's about the average monthly. This says daily. This is monthly. This is meant to be based on bars, and so a lot of times look at this on daily bars. So we're looking at monthly bars now. So the average monthly dollar range in the S&P back when it started was about $5,000. So about 10 points, $500 a point, about 10 points. And as prices rise, theoretically, the ranges should rise as well as a percentage of that price. So for example, at 1,000, 1% is 10 points. At 600, 1% is 6 points. So theoretically that should change. But as you see, if you look at this chart, there's not a lot of change. Even though the market is rising, the change in the monthly dollar ranges stays the same until about 1996, and then it ramps. And so you see that 33,000, it goes all the way up to $33,000 is the average monthly range in the S&P futures, the pit traded S&P futures. So the reason that happens is the psychology of those that are trading it. A lot of the same people trade it, and they trade point values. You think of Dow 100 points. That was a standard measurement of a move. The Dow's moved 100 points. Well, if the Dow is at 100,000, a 1% move is 1,000. If the Dow is at 10,000, a 1% move is 100. So you have to get used to different point values. It eventually has to adjust for volatility. So as this market ramped, it finally adjusted for volatility. So what happened is, as history continues, November 3rd, 1997, S&P futures split. They split it into 250. Point value went from $500 to $250. The tick size went from 0.05 to 0.1. The E-mini S&P futures were created in November 1997, and I'm not a huge fan of the S&P futures. I was not a big fan of that. Of the E-minis. It seemed like a scam to me because you know, now you have the S&P futures that were $250 a point. You trade one contract for one commission, and to get the same amount you had to trade five E-minis to get to the same level, and your commission on 5 E-minis was higher. And so I remember transmitting orders to the pit, and I was always amazed at how quick the pit orders came back filled. It almost was the same as electronic, but not quite. And so as time moved forward, though, we adjusted, and the volume moved towards the ES anyways. And the concept of trading the electronic markets instant order execution was favorable, and so moved towards the E-mini S&P futures instead of the pit traded futures, as the rest of the market did as well. And the pit futures volume is pretty much zero. And so let's look at this. Here is the S&P pit futures from November 1997 until now, and you see how the volume is nothing. It's decreased over time, and now the monthly range is 80,000. So we're talking about $80,000 range. If you bought the low and sold the high, you would make on average 80,000. Or back here 30,000 at the beginning, or 35,000 at the beginning of 2020. Now it's 80,000. So volatility is ramped, and it's ramped since about 2018. You see the same thing happen here as it did in the past. These point values, they stay in this range for what, 18 years. The market stays in that same range for 18 years, even as the market starts to move higher to this point. The market's higher at this point. It's at 2,500. Over here it's 1,000, but the point values, they're still moving to the same point values because the same people are trading them. And then finally the market volatility ramps, and then there's an adjustment in volatility. So I'm talking about this for the purposes of adjusting stop losses. It's not simply just, you can't just simply adjust stop losses and profit target based on a percentage of the price. It has to be a percentage of the range, or it has to be favorable to what the market is doing at the time. And sometimes even though the price is higher, the point values are still the same. And so when that volatility increases, then you adjust, not always based on the value of the index. So let's look at the E-minis and micros. And November 1997, E-minis were also created. Point value is $50 a point. The tick size is 0.25. That was another thing I didn't really like, because it seems like you could get better fills if you're at 0.1 instead of 0.25. And so initially when the E-minis came out, kind of like the crude oil contract, the big contract trades at 0.1 while the QM trades at 0.25. Micros were created about a year ago, and I don't remember the exact date. The point value is $5, 1/10 of the E-mini. So it's 1/10 of the E-mini, same as the E-mini was 1/10 of the big pit traded S&P before it split. It was 500. Then they made it 250. So it was 1/5 after the split, but 1/10 before prior to November 1997. So it's important to understand volatility and the history of how it changes. And so tick size is still 0.25. So 0.25 and the point value is 5. So it's really a 1/10 contract of the E-mini. And so it's another situation where you have to pay, if you buy 10 micros, you're paying more commission than if you trade one mini. So here is a chart of all this. This is the pit S&P futures from 1992 to November 1997. Approximately a $5,000 average monthly range is where it started, right there. And then you see the pit over here, 1997 to December of 2020. But most are trading the E-mini. So you see the volumes decreased over time here, while it's increased in the E-minis. And the beginning of the E-minis, the average monthly range is about 5,000. So right here, and you also see how this has stayed at this level until lately it ramped. And then now the micros, could that be the new contract to trade? It's more accessible to more traders over time as the indexes go higher and higher, and volatility goes higher and higher. So this level is only about 1,800. So it's not quite at 5,000, and the liquidity is still more favorable on the E-minis, but the micros are still there. One of the key points is that in 1997 they created the micros, and volatility did this. See, the market did this, and same thing, they created the micros now, and volatility has gone up even more after they created the micros. So is the cause or effect, what causes it. So it's an anticipation of higher volatility and more accessibility with trading smaller contracts. And so in the future, I wouldn't be surprised if, you know, the micros are the new contracts to trade, and it becomes